Did you know that 6 out of 10 Americans don't fully understand how their 401k works? And this confusion could cost you hundreds of thousands of dollars by retirement. If you're between 40 and 65 and want to maximize your retirement savings, you're in the right place. In the next 10 minutes, I'll break down everything you need to know about 401k accounts in 2026, including contribution limits, employer matching, and the biggest mistakes that cost people money. A 401k is a retirement savings account sponsored by your employer. Here's how it works in simple terms. Every time you get paid, a percentage of your salary goes directly into your 401k account before taxes are taken out. This is called a pre-tax contribution. Section 2. 2025 contribution limits. For example, if you earn $80,000 per year and contribute 10%, that's $8,000 going into your 401k annually. Here's the key benefit: that $8,000 is not taxed today. If you're in the 22% tax bracket, you just saved $1,760 in taxes this year alone. That money then grows tax-deferred until retirement. You only pay taxes when you withdraw it, typically after age 59 and a half. Now, there are two types of 401k accounts. A traditional 401k uses pre-tax dollars, which we just discussed. A Roth 401k uses after-tax dollars, meaning you pay taxes now but withdrawals in retirement are tax-free. Which one is better? It depends on your current tax bracket and where you expect to be in retirement. Generally, if you think you'll be in a higher tax bracket later, Roth makes sense. If you're in a high bracket now, traditional saves you money today. Let's talk about how much you can actually contribute in 2026. If you're under 50 years old, the maximum you can contribute is $23,500 per year. If you're 50 or older, you get what's called a catch-up contribution. This allows you to contribute an additional $7,500, bringing your total to $31,000 per year. This catch-up provision exists because the government recognizes that people in their 50s and 60s need to accelerate their savings as retirement approaches. Now, you don't have to contribute the maximum. Most financial advisors recommend contributing at least enough to get your full employer match, which we'll discuss next. But if you can afford to contribute 15 to 20% of your salary, that puts you in a strong position for retirement. Here's a quick example. If you're 52 years old earning $100,000 per year and you max out your 401k at $31,000, that's 31% of your salary. For most people, 10 to 15% is more realistic, which would be $10,000 to $15,000 annually. Section 3. Employer matching. This is the most important section of this video. Employer matching is literally free money, and you need to understand exactly how it works. Here's how employer matching typically works. Your company will match a percentage of what you contribute up to a certain limit. The most common formula is a 50% match up to 6% of your salary. Let me break down what this means with real numbers. If you earn $80,000 and contribute 6%, that's $4,800 from you. Your employer then adds 50% of that amount, which is $2,400. Total contribution, $7,200. Here's the critical mistake people make. If you only contribute 3% in this example, your employer only matches $1,200. You're leaving $1,200 on the table every single year. Over 20 years, that missed employer match could cost you over $50,000 in lost growth. The absolute minimum you should contribute is whatever amount gets you the full employer match. This is a 100% return on your investment instantly. Check your pay stub or benefits portal to see your company's exact matching formula. If you're not contributing enough to get the full match, increase your contribution percentage today. Section 4. Investment options. Your 401k is just an account. The money doesn't grow by itself. You need to invest it. Let's talk about your options. Most 401k plans offer something called target date funds. These are designed for people who want a simple, hands-off approach. Here's how they work. If you plan to retire around 2045, you'd choose a 2045 target date fund. The fund automatically adjusts from aggressive when you're young to conservative as you approach retirement. When you're in your 40s, the fund might be 80% stocks and 20% bonds. By your 60s, it might shift to 50% stocks and 50% bonds for less risk. Your plan probably also offers individual funds like stock index funds, bond funds, and international funds. If you want more control, you can build your own portfolio. Many financial experts recommend a simple approach. Invest heavily in a low-cost S&P 500 index fund. This gives you exposure to the 500 largest US companies with minimal fees. Speaking of fees, this is crucial. Look for funds with expense ratios below 0.2%. High fees can eat away hundreds of thousands of dollars over decades. A fund charging 1% versus 0.1% might seem small, but on a $500,000 portfolio over 30 years, that's over $150,000 in lost returns. Section 5. Biggest 401k mistakes. Let's cover the 5 biggest 401k mistakes that cost people hundreds of thousands of dollars. Mistake number 1. Not contributing enough to get the full employer match. We covered this, but it's worth repeating. This is leaving free money on the table. Mistake number 2. Cashing out when you change jobs. If you leave your employer and cash out your 401k before age 59 and a half, you'll pay income taxes plus a 10% penalty. On a $50,000 balance, that's $5,000 in penalties plus income taxes, potentially costing you $15,000 to $20,000 total. Instead, roll it over into your new employer's 401k or into an IRA. This keeps your money growing tax-free. Mistake number 3. Taking 401k loans. Some plans let you borrow from your 401k. While you pay yourself back with interest, you miss out on market growth during that time. Plus, if you leave your job, the loan becomes due immediately. Mistake number 4. Investing too conservatively. If you're in your 40s or 50s and your 401k is mostly in bonds or cash, you're not giving your money enough time to grow. You likely have 15 to 30 years until you need this money. Historically, stocks have returned about 10% annually over long periods. Bonds return around 5%. That difference compounds dramatically over decades. Mistake number 5. Not increasing contributions over time. When you get a raise, increase your 401k contribution by at least half of that raise amount. You won't miss the money, and your future self will thank you. Section 6. Action Steps. Here's exactly what to do after watching this video. Step 1. Log into your 401k account today. Find out your current contribution percentage and your employer's matching formula. Step 2. If you're not contributing enough to get the full match, increase your contribution immediately. Even if it's just 1 or 2% more, do it today. Step 3. Review your investment allocations. Make sure you're actually invested in funds, not sitting in cash. If you're unsure, choose a target date fund matching your expected retirement year. Step 4. Check your fund fees. If you're paying more than 0.5% in expense ratios, consider switching to lower-cost index funds. Step 5. Set a calendar reminder for 6 months from now to review your 401k again. Make this a regular habit. To recap, your 401k is one of the most powerful retirement tools available. Contribute at least enough to get your full employer match, invest in low-cost funds, and let time and compound growth work in your favor. If you found this helpful, subscribe to Midlife Money Method for more retirement planning strategies. We publish new videos most times 1 p.m. EST. Next video, we're covering Social Security claiming strategies and when to start taking benefits for maximum lifetime income. See you there. Like and comment. And share.